YouTube, what it do? It is your boy Young Soros here, back with another video, and in today's video we're going to be going over the stock market volatility is reaching 2022 bear market levels. Now, what does that mean? It means that the stock market has not been this volatile since 2022. That is a pretty bold claim considering what we had in 2022. But let's just jump right into it, starting with what happened last week. The bond market absolutely got destroyed. Interest rates hit 4.5% off of a bad inflation print. Inflation went higher, the stock market reacted, and it did not react favorably. And as you can tell by the weekly chart, you have your first big red weekly candle in almost 7 months. That's pretty crazy to think about, but now it is time to talk about a market reversal, aka a buy the dip opportunity for those people who like to buy the dip, or a corrective move to the downside. And I believe the corrective move to the downside is probably going to be the 470 level, which is around the same level you had the all-time highs back in 2022. So, with that being said, there is a lot going on within the stock market. There is a lot to talk about, a lot to break down and discuss. So, if you like what you're seeing, drop a like down below and let's jump right into it. So, starting with NVDA. Now, Nvidia has been stalling for the last couple of weeks, as you can tell. And what do you notice about the stock market? It is also stalled as well. Nvidia has a strong pull on the stock market and everything that is going on. And I have something interesting for you guys. Usually, when stocks run up before they have earnings, they sell off when their earnings come out. It is a prime example of what happened to JP Morgan on Friday. If we take a look at JP Morgan, they are down a large amount and they had good earnings. It's not like they missed on earnings, but if we take a look at the chart, they ran up so much that the stock had to sell off because it did not meet the expectations that this run up had. And that is the unfortunate fate that Nvidia is going to suffer this next earnings season. Now, I said that they couldn't top what they did before, and I was wrong, all that sort of stuff. But the signs are here. Nvidia has definitely topped out. Now, could it go back up? Yes, but signs are saying that Nvidia is topped out for now. It's reaching its monthly moving average, and if it closes below that, that is not a good sign. And there's a lot of volatility in the markets that can affect Nvidia in more ways than just one. AKA, you have oil, you have Israel, you have Iran. Those are affecting energy prices. And if you know anything about the market, they do not like inflation. So, what happened on Wednesday? Wednesday, CPI came out. It was hot, hot, hot. And inflation, it decided to take the market by storm. And the stock market dumped. Now, what's interesting about all of this is that even though inflation went higher, the stock market thinks a rate cut is still a possibility, but rate cuts have been fully priced out of June, and now the stock market is talking about one rate cut. If we take a look at the Fed watch tool, it's been completely priced out of June and even July to some extent. This rate cuts have been priced out. So what does this mean? It means that the Fed's next best choice is to hike interest rates. Now, I'm not saying that if the CPI stays at this level, the Fed should hike. What I'm saying is that if inflation decides to pick up where it left off and decides to go in a crazy direction, and then you have oil and energy going crazy and all these inflation trades going crazy, then yeah, the Fed needs to hike rates. But if inflation stays the same, then the Fed can hold interest rates but not cut. The worst thing you want to see right now is a Fed rate cut. And unfortunately, I still think this can happen. But if you see a Fed rate cut, that is the worst case scenario because, like in 2020, you had a Fed emergency rate cut. And what happened in 2020? You had a pandemic and the entire US was shut down. And that is the only reason the Fed cut rates. If the entire U.S. economy didn't come to a screeching halt, the Fed would have never cut interest rates in 2020. Now, I digress by saying that the stock market wants this interest rate cut to happen, but it's all smoke and mirrors. It is a buy the rumor, sell the news event. And the sooner they cut interest rates, the worse off we are as an economy. Because now you gave inflation a runway to just take off, as well as you're cutting rates for the fact that the economy is in an unsalvageable state unless you cut rates. The economy is broken. They broke something. That is the reason why the Fed cuts rates. They never cut rates for the goodness of their heart, which is what people get misconstrued about interest rates and interest rate hikes and the cycle of cutting and hiking interest rates. That's what people get misconstrued. Let's take a look at the 10-year. Yep, 4.5%. That is just ugly, ugly, ugly. Last time we were there, we were at the lows of October, November. We were at those lows. And if the interest rates decide to just keep running up, we hit 4.7, the stock market is going to respond. It's already responded, but the higher these go up, the more the stock market is going to turn its head and say, we cannot do this anymore, and they will start to sell off. Now, what's interesting about this, however, is that take a look at this. Take a look at this. April is projected to have a 2% return almost 80% of the time. So could we see a Monday open green, or could we see the Monday open red and then we rip green and then see a short squeeze? It could be, but you got to keep your eye on April being a 2% up month 80% of the time. And we are going through a lot of economic pressures from Iran and all these other sort of things. And if these things either get resolved or they get ignored by the stock market, that could really fuel, this stock market that could really fuel this stock market drive higher. But will it surpass new all-time highs? It could be, it could not be. I still think this is a deeper pullback that we're going into. Now, as for what's happening with the biggest stock in the world besides Nvidia, Apple. Apple has been getting destroyed, destroyed, destroyed over the last couple of months, and it just keeps getting worse. Their shipments have declined in the first quarter. This just came out less than an hour ago, and that is so brutal for Apple. And Apple is one of the leading stocks of the Magnificent Seven. So if Apple is doing bad and can't hold their own, then what is to say that other companies are going to follow suit? Because if Apple can't do it, then what other companies will besides Nvidia? Take a look at the Fear and Greed Index. What's interesting about the Fear and Greed Index is that even though we're almost tipping into fear, we're kind of in neutral, the stock market momentum is still at greed. You have stock market breadth still at greed. And guess what? Guess where the 125-day moving average is? It's at 470, 480, which is the same spot we had the stock market all-time high. So if we don't hold that stock market all-time high in 2021, if we don't hold that zone, that 480, 470 zone, if we close below that zone, it is going to be real ugly for the stock market, and it could look like the summer of '07 where you had the start of the stock market crash. Now, if we take a look at here, market volatility has spiked. It has spiked drastically, and it's getting up to the heights that we had in October. So that is very interesting. It's something to keep an eye in. We have not had this volatility all year, so we will be keeping an eye on the stock market volatility as well as safe haven demand and junk bond demand. It is all at extreme fear, and extreme greed. This is really, really bad considering all the things we just talked about. And hopefully, Iran does not do anything too crazy to make inflation pressures worse, because that's what the stock market is dependent on. It doesn't care about the war itself. It's just worried about what is it going to do to oil prices. If the stock market if if oil prices don't go anywhere, then the stock market is going to ignore the Iranian war and continue on with their lives. If oil jumps another $10 a barrel because of the war, the stock market is going to be put on notice. So you got to keep that in mind when we are discussing what's next for the stock market. And let's just take a look at what happened. 1.6 on the SPY, 1.4 on the spot. Uh, let's take a look at what happened recently. 1.6 on the Nasdaq, 1.4 on the SPY, 1.2 on the Dow. And this has just been over the last couple of days. The stock market has been in this extreme volatility mode where the last 3 days you had 1% moves, which is kind of crazy to me to think about. So one more thing, you have to look at the real estate and energy sectors the most going forward in over this next week all the way until June, which is Jerome Powell and when he comes out with the summary of economic projections. So what to watch for next is going to be energy and real estate. I say real estate because if you take a look at real estate, it has been dumping over the last couple of weeks. And yes, that is because of interest rates. But if we take a look at what happened with oil, oil has also been rising extremely aggressively over the last couple of weeks. And this is before you had the war in Israel. Oil was just starting to break out, signaling more inflation, aka higher rates for longer. With real estate, you don't want that because that insinuates higher interest rates, higher higher for longer, and that is bad on the real estate sector. And it is coming off of its moving average, and if it closes below this moving average, that is going to be really bad for the real estate sector. Now, as for energy, energy is doing amazing right now. They're breaking out, and if it can go above this high that we had set in 2014, that is going to be a problem, and Jerome Powell is going to have to face energy head on by either not cutting, but raising rates or saying we're holding higher for longer. But their best bet right now would be to hike rates. Yes, the Fed should hike rates. Are they going to do it? No, they're not. And why do I say that? Because inflation is still rising, even though we have a 4.5% interest rate. I want you to think about that for a second. You have interest rates at 4.5 and inflation is still rising, and we haven't even cut rates. We haven't even cut rates yet. So if the Fed were to cut rates really, really bad, they need to raise rates and they need to do it quickly, or else we will have a stagflation scenario. So that is it, ladies and gentlemen. That is it. It has been your boy, Young Soros. Peace out.